Hey everybody, John the Economist here again, and today's lesson is actually going to be covering just the baseline basics of technical analysis. So I've been doing this YouTube thing for like 3 or 4 months now, and there are times where I have viewers that are watching, what I say or what I'm talking about, and can't totally follow what I'm saying because, unfortunately, with my economics background and my finance background, my vernacular does kind of start to use like a decent amount of jargon, right? And if you can't totally follow what some of those words mean or exactly what I'm referring to when I'm using some of those words, it's very difficult to kind of follow exactly what I'm saying here. So I'm going to do this YouTube series of like basics of technical analysis, basics of economics, and basics of finance, where I'm really just focusing on like defining a lot of these things and just like the very basic level of like what these things are, what are some really commonly used words and terms when discussing these topics. And the intent with that is then I hopefully don't have to backtrack or explain things as I'm streaming quite as much. And I can just refer you to this short video series in order to kind of learn some of those baseline things. And also, if you got referred here and are now watching this video as a result, welcome and thanks for taking the time to check it out. So one thing that I want to get out of the way with technical analysis is there's technical analysis is used for you to create roadmaps and definitions around your risk, the trades you're making, your entry and exit points, things like that, right? This is not an exact science. It works for people. It works very well for a lot of people, but there's a lot of nuance involved to how it works and just what works for certain people, right? So everybody has their own style, everybody has their own way of interpreting this data, everybody has their own indicators that they use. I'm just going to try to show you the definitions, what some of those things mean to me, and kind of what I'm looking for when I'm doing some sort of TA. And then some of the indicators out there that you can use in order to kind of start your trading journey, right? So additionally, we're going to use the crypto market as kind of the intro for this. And the main reason why is because the crypto market trades 24/7, while equities trade, it depends, but usually from like 9 in the morning to around 4 in the afternoon, Monday through Friday, not including holidays, right? And so what happens is, most people are used to looking at data as a line graph, right? But now we introduce these bar charts. Oh, what's going on? All these bar charts are doing are telling you the price action within a set time frame that you set it to, right? So, for example, we're on the daily chart right now. So each one of these candles represents the price action that Bitcoin had on a particular day, right? So this one that I'm looking at right now, this like big blue candle that you see is from February 4th, for example. If you were to go over to equities though, right, you see these gaps in the price action because of weekends and after hours trading, right? So they don't line up quite as perfectly, so it's a little bit more difficult to explain. So the first thing that I want to talk about is just like, what are these candlesticks? What are they trying to tell you? Why are they more useful to use versus a line graph? And it might look a little daunting at first, but trust me, once you get used to staring at them, it becomes second nature. And I very much prefer it to looking at line graphs in most instances now. So what you're looking at, I'm trying to find one just like with a nice mix of everything. Let's take a look at this one, right? So we're going to look at this July 1st candle right here. So the body of the candle represents the open and the close. In the crypto market, the candle will always open wherever the last candle closed, right? So at the end of the one candle's 24-hour period, that's the exact same price that the next 24-hour candle will open at. And then these wicks is the range that the price occupied during that entire day, right? So on July 1st, 2022, Bitcoin saw a price as high as $20,904. It saw a price as low as about $18,900, $19,000, right? It opened its day at 19,974 and it closed its day at 19,235, right? So that's why this candle is usually they're green and red, but why this candle is a purple instead of a blue is because it closed lower than where it opened at for the day, right? And then you can see there's another tinier one where it had a much tighter range, right? So it actually opened at that price and then ended up closing just a few dollars shorter than that, occupying a range between $19,400 and again about 18,960 or so. More of the same on the candle following it, except it actually had a green, or in this case, a blue day where the price increased. And then you actually see a larger blue bodied candle right here, right? Same concepts. The candle from the day prior closed at 19,296, which is where the July 4th candle opened at. And then even though it occupied a price as low as $19,020, it actually closed its day all the way up at 20,210. So that's what candlesticks are telling you. They're showing you the range that the price occupied during that particular time frame. They're showing you the open and the close of that candle as well, right? And again, we're looking at the daily chart, but you can also do this on a 4-hour interval. You can do it on a weekly interval, right? This is what Bitcoin's weekly chart looks like. You can do it on a monthly interval, so on and so forth, right? But again, what this does is it gives a more easy to digest version of Bitcoin's price data as far as performing technical analysis, which moves us on to the next point. Okay, cool. So we have this data, we can see this data set. How does this help me trade, John? Like what you said, this helps for risk management and helping assess where you should enter and exit. All this did is just provide a new fancy way for me to look at price data. You are correct. So what you're going to do after that is then this is where the astrology for men part comes in. For those who don't know what I'm talking about, people say technical analysis is astrology for men. Is then you get to draw all these really subjective, nuanced lines on what's referred to as support or resistance, right? And support is an area that you would look towards for the price to hold and then continue up from, right? It would be where you'd look for, a bottom or a short-term bottom or something like that. While resistance is a price level that, the asset would traditionally struggle to break through, right? And generally, when you fall under support, that becomes new resistance. When you go above resistance, that becomes new support, right? So the way that me being an economist looks at this is it's just supply and demand. It's price areas within the asset where more supply is likely to come onto the market, which obviously will decrease the price, or prices where demand comes in and people are more likely to want to buy at that price, which obviously will increase the price. So one way to look at this, some people like to draw these lines like down to the dollar and they like to trade things down to the dollar. I'm not that fancy or exact with it. I like to use generalized price ranges. So let me go to, there we go. All right, so now we have support and resistance lines. John, what's going on here? So this is where the candlestick data becomes helpful because like looking at this weekly chart, for example, I can see in this range, like this candlestick wicked down to like this 28 to, $31,000 range once, twice, 3 times, 4 times, 5 times, 6 times between late December of 2020 to about July of 2021. So over like a 8-ish month period, there were 1, 2, 3, 4, 5, 6, 7 weeks in which it came down to that price, but it didn't fall beneath it, right? So then we'd consider that area support. It's an area where new buyers come in and have demand at that price because they think that they're getting the asset at a price that's valuable to them. Alternatively, Bitcoin failed to break into, I would say, just 70K on two separate occasions. We have, what's referred to as kind of a double top situation as a result of this. So we topped out at about 65,000, but I would say, if you're actually just going to look at this top here, like the 60,000 range was the true, resistance during that time. We could never get a candle close above that. And then over here, more of the same, except add like $5,000. Like we were struggling to close above like 66,000. Everybody thought we were destined to 100K at that time, but we never really got above 70. In fact, we topped out at $69,000 to the dollar, depending on what exchange you use. So what you're seeing there then is this is resistance. This is where sellers are coming into the market, and the price can't advance past that level because of the fact that the sellers are coming in and dumping new supply onto the market at that price range, right? So you have support, you have resistance. Then a lot of times within these two broader ranges, you'll have plenty of smaller support and resistance throughout. So I'm going to switch back to the daily chart so that we can look at this. So this $40,000 to $42,000 range, I considered for a long time the point of control on this range, right? So $30,000 is your, long-term macro support. 70,000-ish dollars is your large macro resistance. And then between that, you have the 40K or so range in which it's like splits this range in half. And you can kind of see like there was a lot of like big, reversals in the price momentum around that $40,000 range. But again, none of this stuff is gospel. So I'm going to walk through when I kind of was treating that as gospel and then how that actually came to sort of hurt me later when I was trading because I was too stuck on these arbitrary lines being important when maybe they had passed their prime at a certain point. So if you see here, when we first rallied up, we actually topped at about $42,000. And then we immediately came back and tested like $29,000, $30,000 as support, right? So we broke past it. And then we came down, we tested the support on 4 separate days, that we kind of had closes around there. And then from there, we had the confidence to move out of that range, right? And then I'd say this was, even though we didn't really visit it during this time period, still kind of acted as that like, middle point support for the asset. Then when we broke back beneath it, again, we almost immediately went and tested $30,000 of support, right? We had this big capitulation that happened on May 19th, 2021. You can see even though the candle closed at $36,000, we actually went all the way down to 30K on that day and bounced back up, right? And then I feel like we were just wedged between that $42,000 resistance range and that $30,000 support range. And for me personally, this ended up, working out as some really good trading overall. And I'll kind of explain what my logic was and some other things once we kind of get done with the support and resistance thing. So, we tested that as support. We came back up to 40K, rejected, right? Which means the price tried to advance there and failed. So then, we mess around a little bit. We tried it again, got up to that point again, failed. What did we do? Went back down to that $28,000 to $30,000 support range. And what did we do? We successfully held it as support once again, moved up, ran out of steam once again, came back down, tested it a third time. So over this roughly like 60-day range, we ended up testing 30K as support on 3 separate occasions, right? On that third occasion, it was the market finally had the confidence to really rally strongly back up to that $40,000 level. And even then, we still ran into resistance there, right? We actually struggled to advance price. We corrected a little bit, and then we had the confidence to move out of it, right? And you can see And again, when I'm saying support and resistance, it's new supply on the market and that's new demand coming on the market. When we were at this 30K, like people obviously had demand at 30K. They were coming in and buying Bitcoin at 30K. It did not spend a lot of time at that price level whatsoever. People were generally coming to sell Bitcoin at that 40K, 42K range. Finally, the sellers at that area were exhausted. They were done selling at that area and the price advanced. It advanced for a while, for around 3 weeks. And then what did we do? We tested the former resistance as support. And you see this a lot in technical analysis. It's one of the key things to look for. Is after you break over a key resistance level that you are struggling with, it's generally you generally look for a situation in which you come back down and test that level as support. And we beautifully tested it as support back then. 1, 2, 3, 4, 5, 6, 7, 8, 9 days in which we were testing that 42K level of support, and we didn't fall beneath it, right? Demand came in at that level rather than supply, right? So that's how when you break above a prior resistance, it becomes new support. In the same way that if you break underneath a prior support, it becomes new resistance, right? What generally was an area where new supply was coming into the market then became an area in which new demand was coming into the market. So from there, we made one rally up, pretty much straight back up to that 60K range. There was a lot of excitement. People were very confident in the price action of Bitcoin at this time. There was a few other technical indicators that gave people a lot of confidence in reference to Bitcoin's price action, but it wasn't enough to get us there. Too many sellers were coming in during this period. There was a lot of macroeconomic uncertainty, and that's what set Bitcoin on its trek to where we are today, where we're, messing around in the like low to mid 20,000s. But let's continue our story here because I think that it is useful. So when it was time to start going down, the first thing we did was immediately capitulate straight down to that 42K level and hold it as support, right? And then we came back down again and we had another attempt to hold it as support and we lost it. Okay. And from trading so well in this range, I came into this range with a lot of confidence. But what do you notice about this versus this? Take a look at my arbitrary imaginary lines, right? If I'm respecting these lines as support and resistance as areas to buy and sell for a while, then I was crushing it here. If I was doing the exact same thing over here, I was getting slaughtered. And sure enough, this was probably the worst era of trading I have ever had because I could not get where the actual support and resistance of the asset was. And it was driving me insane because what I previously thought was this really important, $40,000 to $42,000 level was getting crossed up and down and up and down and up and down all the time. And if I was previously using that as a really important level to trade with, I was going to struggle with, coming to terms with the fact that that's no longer a level that people were respecting as an area where new supply or new demand was going to enter the market. So, lessons learned. We eventually did end up breaking beneath that and then trying to hold 30K as support for about 2 weeks. All of the buyers there became exhausted, so it was time to go lower, right? And then to me personally, the actual support and resistance got a lot more abstract because we're just basing this off of the 20K top or, the like 10 to 14K range that we did back in the 2019 bull market. I really need to upgrade TradingView. I'm sorry that I'm so frugal. It's so bad. I use this thing every day, right? But anyways, so, we came and we hold that 20K, region as support, but like, I'm not super convinced of a lot because of the fact that like, it's kind of a dubious support. We're pretty much just basing it off of the previous all-time high here. It's a little more abstract for me. And so right now, I'm personally just saying I see value in the price action. We are at historically low levels. We have several indicators that are trying to suggest that. I'm dollar cost averaging. I'm not trading. I usually become more apt for trading in bull markets, and I become less apt for trading in bear markets. Bear markets, I'm just buying blindly. I don't really care to make crazy, impressive trades or, try to, scalp any particular, run that the asset goes on in a bear market, because all I know is that I'm loading up at a good price point. And when it eventually looks bullish again, that's when you can start playing around with the money again. Again, that's my philosophy. I'm not saying it should be yours. Okay, cool. So we got support and resistance down. Why do you have a non-horizontal line here, John? Well, while looking at ranges of support and resistance, you should almost always use horizontal lines. Always, always, always. They are better roadmaps. They won't disappoint you. It makes a lot more sense. The actual price data is a lot more concrete and hard set. So then these diagonal lines are referred to as trend lines. And I will, again, this is my personal philosophy. Do what you want. I do not treat trend lines as support and resistance. I use them to identify a trend. Let me repeat that again. I do not use diagonal lines as support and resistance. I use them to identify a trend. What does that mean, John? What that means is that if we were to break under this line that I drew, I'm not treating that as a trade. I'm not treating that as a loss of support. All I'm using here is a general trend in which I need to start paying attention, right? So let's say this is a downward trend line that I'm using, which a lot of people are using, and it drives me nuts when people trade like this, right? Okay, there's our big trend line, right? There's our top. There's our attempt to break out of it that we failed. And now, we're going to see maybe Bitcoin does something like this. Oops, that's not my drawing tool. I'm sorry. Control Z that. There we go. We might break out of it eventually. There's nothing to trade here. That's not important. It's not important. And most people that trade off of breaks of diagonal trend lines end up in a really bad situation more often than not, because it's not really telling you a lot. It's just telling you broke past the diagonal line. Additionally, these horizontal lines can go on for infinity of time without changing, right? I can take this horizontal line and make this go until 2026, and the context doesn't change. These diagonal lines imply a certain time preference for what the asset's doing, right? So if I sit here and extend this, like, we got to break out of it eventually or we're going to zero. That just has right? So again, that doesn't mean we'll trade. There's a trade there. We could break out of it here. We could break out of it here. We could break out of it here. We could break out of it there. At what point is that the trade? I don't know where I'm supposed to enter off of that, right? It's not super relevant to what the actual price action is doing. It's just helpful, right? When you break out of a trend line like that, maybe you can start paying attention, look where the nearest horizontal resistance is above, and then say, okay, if we break out of that, then I can look at actually, waiting for a test of support, making an entry, and seeing where the price goes from there, right? Break out of that, wait for a test of support, make an entry, see where it goes from there. So again, risk management. That's not predicting the future. That's just, okay, we went, we tested this as support successfully. It looks like we're coming off of it. There's probably a decent momentum price move off of that. Now, the thing that people struggle with when they get good at TA and they get good at this type of price analysis is then taking exits, right? So you could have ran that up 60% if you made entries at that 42K range and then met at that next resistance. And a smart trader would have rode that up, realized they're up 50%, and said, okay, we're struggling at the next resistance. It's time to take an exit and then start from scratch, see what's next, right? That's how a trader that's used to this would trade. Some people get really excited they made a good entry and then they're back to being investors rather than traders, and they just want to hold on to the asset. And then, when it does this, oh, okay, really impressive entry, dude. Right? So things to look out for. All Also, if you have any questions about the words that I've used or any other explanation, feel free to drop it in the comments. I will make sure to respond. Again, this isn't supposed to be an intro. It's supposed to be informational. Okay, let's take a look at what some of these other lines that I have are. We're not going to get to RSI today, so I'll just go ahead and remove that. This thing down here is the volume, right? This is the amount of price action that's happening. You usually like to look for confirmation of particular types of price action through increasing volume, right? It gives you the kind of momentum confirmation that you need in order to believe that what just happened with that price action was legit. Not always, but it's useful. A really great example of this is during this top here that people at the time obviously were not convinced was a top. There wasn't any volume, and people kept asking that, and so did I. And I was like, "Where's the volume? Where's the volume? Where's the volume?" And people didn't seem super concerned with it, and so therefore I stopped being super concerned with it. But you'll see that like right now on this potential bottom, I'm not super convinced that this is a bottom yet on Bitcoin. We're seeing increasing volume here, which means a lot of buying went on, right? That's what all that's going. It's not a lot of selling. If it was a lot of selling, we just continue dropping, right? We already had that point. We had two huge spikes in volume, and what do we see on those two huge spikes in volume is a lot of selling. Now, tons and tons and tons of volume, but we're not seeing any more downward pressure. So that suggests that there's probably more buying going on in that range than selling, or a mixture of both, right? So something to look out for. Really useful. Okay, so we have our lines, our support and resistance. We have our trend lines that are helpful sometimes, not really. And we have our volume profile. And the other thing that I like to use are moving averages. And we're going to switch to the weekly time frame here. So moving averages are great for obviously compounding a moving average of previous price data and then using crosses of those moving averages in the same way that you use support and resistance. If you want to use support and resistance that isn't straight horizontal, don't use a trend line, use a moving average, right? For example, Bitcoin has been really good at holding its 200-week moving average as support throughout its history as an asset. It was essentially the bottom of the 2015 bear market. It was the bottom of the 2018 bear market. It's where we had our weekly closes at in the March 2020 COVID capitulation, and it's where we're at right now. So again, people have historically used that as a bottom indicator. I still think we have room to go lower because I don't think, moving averages, even though they're long-term moving averages, are gospel. I think that, considering the macroeconomic uncertainty, recessionary pressures, things like that a risk-on asset like Bitcoin could stand to go lower. But again, that's not going to deter me from seeing value here and thinking, okay, this is a really great long-term entry point. Like, this is an entry point that only pops up once every couple of years if you've been tracking Bitcoin's history. So I just generally think that it's not a horrible spot to look for support, or at least start to build support off of to channel another move up. I've also given Ben Cowan a shout out on this channel more often than not. He uses this blue and gray moving average here, which he refers to as the bull market resistance band or the bull market support band. When Bitcoin is in bull markets, this tends to be a band that it uses to build support off of and have a really nice move off of. And when we lose it, we can generally consider that the trend is bearish, right? Oh, another thing that I should mention. What's a bull market? What's a bear market? Bull market, big line go up. Bear market, big line go down. For how long? That's subjective, right? But that's, people say bullish and bearish. Bullish means price appreciation. Bearish means price depreciation. The other thing that I want to talk about with bullishness and bearishness, and I think from here we'll kind of wrap up the video. I'm going to get rid of all of my crazy lines going on. We're going to go to a nice, clean Bitcoin chart. It's just this idea of higher highs and higher lows because people use them to identify a bearish or bullish trend. And I want to talk about this because when you say higher high, higher low, lower high, lower low, it kind of gets confusing as to what people are saying. So again, this is a jargon definition video. I want to make sure I cover it because it's something that I mention often in my live streams. So what a higher high and a higher low is suggesting is a bullish trend. What that's saying is that every single time there's a high, and the next high goes higher than the last high, a higher high, right? Uh, Sorry, I pointed as if you can see what I'm pointing to on my screen. This high is higher than this high, and then the high after that was higher than this high, and then the high after that was higher than that high, right? So that's a textbook bullish trend. Same thing with the lows. You're getting higher lows. So then when the price goes down, the area that it catches itself on the lows are consistently higher as well, right? So you're seeing higher highs and higher lows. Now, where Bitcoin was showing weakness in this distribution phase here is then, right, we had a low and then we had a lower low and then we had a lower high. And people were still convinced that, oh, there still might be some saving on this bull market and stuff. But the signals were telling us that the trend was about to flip bearish. Now, again, this isn't gospel. This isn't what happens every time. But if you think about it, if you have, what is this, like 6 months straight of higher highs and higher lows, and then finally you're showing some divergence from that trend, you print a lower low, you print a lower high, right? And then from there, it was nothing but lower lows and lower highs for a while, right? So there's your low. There's your first lower low. Here's your high. Here's your first lower high. And then lower low, lower high, lower low, lower high, lower low. And then it was breaking out of that and once again going back to printing higher highs and higher lows that we were in a bull market again, right? So I think I'll wrap it up at that. We're at 32 minutes. Hopefully, this was a decent intro to technical analysis for you if it was your first time getting exposed to it. There's a lot of other indicators that we can mention, right? There's, things like logarithmic regression I like using. There are things like the RSI, which is a great tool that I'd be happy to explain at some other point. You can switch the type of candles that you use, right? You can use Wyckoff technical analysis, which taps into like certain psychological and institutional elements of the way markets move. You can use MACD, Bollinger Bands, et cetera, et cetera, et cetera. Everybody has their own style and their own way of doing technical analysis, but what's important is this idea that we're looking at candlesticks to get the data in a way that's easy to digest, and then we're looking for support and resistance off of that. That is just the general basis, and there's just 1,000 different ways to try to do it, right? So anyways, I hope that you enjoyed this. Finance is something I picked up through just my passion for markets and things like that. Economics is my true bread and butter. I have a master's degree in economics. Like I'm an economist, right? First and foremost. So the next lesson is going to be covering the basis of economics. And then we're going to marry all this beautiful technical analysis stuff with the beautiful economic stuff and kind of get like a decent, finance lesson going as well. So looking forward to that. Hopefully this was helpful. Again, if you have any questions whatsoever, feel free to leave a comment or message me directly. I am happy to help, and I hope that you have a wonderful rest of your day. Peace.